Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week is episode 94. And this week on the podcast, we're going to cover 4 different tactics, 4 different separate strategies you can use to reduce capital gains taxes on appreciated assets. And the context, the background here is that we've had a long bull market, really since the bottom of the mortgage crisis in 2009, when the Federal Reserve decided to start injecting a lot of US dollars into the monetary system. And since then, those dollars have found their way into capital assets and really driven up the value of pretty much all capital assets. And a lot of people around the country and around the world now sit on large appreciated positions of stocks, sometimes bonds, sometimes cryptocurrencies. There are a lot of different assets that people are holding where they're not necessarily comfortable with being so concentrated in that position, but they don't want to sell for tax reasons, because if they did, it would come with a substantial taxable capital gain. If you're in that situation, there are a few things that you can do to reduce the capital gains taxes that you might pay. And this week on the podcast, we're going to cover 4 of those different strategies. I hope you enjoy it. Hey everybody, real quick before we jump into today's episode, I have been advised by my attorneys to remind you all that none of what you might hear in today or any other episode of Grow Money Business is financial, investing, tax, legal, fitness, or even relationship advice. It's content that you're free to use and deploy on your own terms. And before you take any actions on what we might cover in the show, I really encourage you to consult with your accountant, attorney, or financial planner. If you don't have a financial planner and think that you might need one, be sure to check out threeoakswealth.com to learn more about my firm's planning, advice, and investment services. This week on the podcast, we're talking about what you can do if you have substantial positions, maybe concentrated positions in specific stocks or specific assets, including cryptocurrency, that you might not want to sell purely just for tax reasons. And there are a lot of examples of why this is cropping up, particularly in 2021. Number one is a lot of people who have substantial positions in various cryptocurrencies are in this situation now, where if you sold the cryptocurrency, maybe if you've bought Bitcoin 5 years ago and now you have a 7-figure position in it, you probably don't want to do that for tax reasons. You would pay a substantial amount in long-term capital gains tax, potentially as much as 23.8% on the gains, which is still quite a bit lower than what we've seen historically tax-wise over the last 100 years in this country, but is still about a quarter, before you even account for state tax, it's about a quarter of the value of what you're holding. And so if it's the choice between continuing to hold that asset, whether it be cryptocurrency or company stock or any other asset under the sun, really, if it's the choice between holding that thing that has appreciated so greatly and selling it and paying at least 25% or so in tax on the gains, a lot of people say, you know what, forget it. I'm going to keep riding the horse that got me here and remain invested. I don't want to sell it for those reasons. And that's a pretty substantial mistake for a lot of people. Number one, we have these situations over the last 20, 30 years where people working for a large company have a very large portion of their net worth in the company stock. So you think of WorldCom, Enron. There are a number of these examples where the company was doing great. It was on the uptrend. The employee morale was very high. You're making more and more money as an employee there. You're getting paid in company stock. The price of the stock is going up, and you've drunk the Kool-Aid. You're all in. And at some point, when the price of the stock goes up by enough, now all of a sudden that company who's
not only signing your paychecks and providing your health benefits is also a huge percentage of your net worth. And so, yes, it can make you very wealthy being so concentrated. I mean, look at like Jeff Bezos is very concentrated in Amazon shares, and he's fabulously wealthy because he built the company. It comes with a tremendous amount of risk because from time to time, individual companies get cut in half, their market values get cut in half or worse. There are accounting scandals. There are all sorts of things that can drive a company's value to zero. And that just presents a whole lot of risk. So one thing that we run into quite often in the financial planning firm is somebody who works at Apple or Facebook or Google or any of these big tech companies that have very generous stock programs that they provide to their employees. So you might be paid a cash salary, you might get group benefits, health and otherwise. You might have a 401k, maybe the company puts in some money on your behalf through a match or some other mechanism. And then there's the employee stock purchase program. You can buy shares of the company at a discount. There are restricted stock grants. Oftentimes part of your bonus is paid through company shares that vest over time. There are also stock options, incentive stock options, non-statutory, non-qualified stock options. There are all sorts of these mechanisms that employees of large companies are paid in to align the employees' interests with that of the company. And by and large, that's a really good thing. The byproduct of that is if you've been at Apple for like 15 years, you probably have a whole bunch of Apple stock. And while that has done very, very well, it just presents a lot of risk to your personal financial situation. And so the issue that a lot of these people are faced with is, well, I don't really want to sell the stock because I don't want to pay tax on those gains. That's just a lot of money. So what do I do about it? And the same goes for crypto investors who have been around for a little while and have substantial gains in their cryptocurrency holdings. You might not want to sell it for tax reasons. And even though, it's driven your net worth up by, in some circumstances, a whole lot, if 70 or 80% of your net worth is tied up in these cryptocurrencies, it really presents a lot of risk. So that's the background for why I wanted to cover this topic specifically. It could be cryptocurrency, it could be company stock, it could be any stock for that matter. A lot of people just have concentrated positions with a substantial taxable gain. That's the bad news. The good news is that there are a couple things that you can do about it if you're in this situation. So I'm going to cover 4 strategies today. They're by no means exhaustive. There are a lot of other strategies than what I'll cover today, but these are 4 pretty common ones that tend to work pretty well. Some of them work for cryptocurrency as well, specifically 2 out of the 4, to my knowledge, but all 4 work for company stock, publicly traded company stock, I should say. So I'm going to share 4 of these strategies. We're going to go over them in a lot of detail. Like most of our podcast episodes, I haven't done a whole lot of prep, so this is a little bit off the top of my head. And if I can't recall the specifics of any of these 4 strategies, you'll have to forgive me, but that's a good cue to talk to your attorney and or tax advisor about this stuff. So I'm going to start with my least favorite of the 4 and work down the list, getting progressively closer to my favorite of these 4. My least favorite is what's called an exchange fund. This is one that does not currently work with cryptocurrency, to my knowledge, but it does work very well with appreciated company shares. If you work at Facebook, Google, Amazon, Netflix, Apple, you've probably heard about this already, but it's called an exchange fund. It's my least favorite of the 4. Well, let me postpone the drawbacks. Let me tell you about the benefits first. The benefits are that there are a lot of people around the country and around the world who are in the same position that you are. You have, let's say you have $10 million of company stock. You were an early employee, the company's done very, very well, and now your holdings are worth $10 million. If you work at Apple, there are early employees of all the other corporations that are relatively new, I should say, in the US who are in the exact same position. And so whereas your $10 million holding presents a lot of concentration risk, if your net worth is $11.5 million and 10 million of it is in Facebook stock, then you have an issue on your hands that you might want to manage a little bit. Well, there are other people just like you that work for other companies all around the country. And so the idea is with an exchange fund, you put some or all of your stock into this fund along with everybody else working for other companies. So if you put 10 million in, everybody else puts 10 million in, and in exchange, you get shares of the combined fund, which essentially diversifies your investment without triggering a taxable gain. So simple example, if there are 500 people who want to engage in this, one for every single corporation in the S&P 500, each of those people put $10 million of their company's stock into the fund. Now you're swapping $10 million of Facebook stock for $10 million of basically the S&P 500. It'd be weighted a little bit differently than the S&P 500 index, but you're immediately diversifying your holdings without triggering a taxable event. So that's really appealing to a lot of people. It comes with some substantial downsides. Number one, in order to avoid the IRS rules for triggering a constructive sale, you have to have a lockup period of at least 7 years. So that means that you can't pull your money from that combined fund, exchange fund, or in our example, the S&P 500 for 7 years, which is limiting. And on top of that, usually there's a pretty substantial minimum, like a $5 million liquidity minimum. And these funds are not subject to SEC rules. So there's not as much accountability as you would normally want in a security like this, which means that sometimes the reporting is not as good as you might want. And it just comes with a little bit more regulatory risk because there are not regulators over the shoulder of these funds. So there are some substantial drawbacks, but it's a nice way to immediately swap what you have for a diversified basket of a bunch of other companies. Now, you can also do this with private companies. Publicly traded companies are not the only securities eligible for this thing, but you have to find the right basket, because if you're going to mix wits with a lot of other investors in this exchange fund, you probably want to know that the other companies being added to the fund are viable and have at least a minimum amount of financial strength. So clear benefit, there are some drawbacks. They're expensive too. Most funds that I've run across will charge you like a one-time enrollment fee and pretty substantial ongoing fees. And if you're comfortable with that, if the benefit is of avoiding the tax and diversifying out of your concentrated position exceeds the fees of the fund, then yes, it's still a good idea. But those are the chief drawbacks. The second one, my second least favorite option. These are all good options. I don't mean to paint a negative picture here. But the second option is what's called a cashless collar using options. And this is one that doesn't work for private securities. It doesn't work for cryptocurrency unless you can find someone who's willing to write you an option, which does not exist yet, to my knowledge. It currently only works with publicly traded securities. And so in a stock option, an option gives you the right to buy or sell a specific security for a specific price for a certain amount of time. And once that window closes, the option expires, you no longer have the right to transact in the manner the option specifies. And so this is a really nice way for a lot of investors to hedge their securities. Because if you own Apple at 100, let's say the price of Apple is 100, you have $10 million in company stock. Well, if the shares fall to $70, you're out a whole bunch of money. One way to minimize that risk is to buy what's called put options, which gives you the right to sell, in this circumstance, Apple shares for a certain price for a certain amount of time in the future. So let's say that I'm recording this episode in September. You could buy maybe December options. And either the second or the third week in December is when options expiration happens. I can't remember. It's been a while since I've looked at it. But the idea is that between the time that you buy the option and the time that it expires in December, you have the right to sell a certain number of Apple shares. In this case, you would buy enough to be able to sell your entire position, theoretically, until December. And so if the price falls to $70, yeah, the value of your Apple stock falls by 30%. But simultaneously, the value of your put options rises substantially to offset that loss. So it's an easy way to hedge downside risk because you hold the option. The downside of it is you have to keep buying more and more put options because these things aren't good indefinitely. They expire periodically, and in order to provide that kind of downside protection, you have to keep buying more and more every time they expire. So the cashless collar that I'm describing is a way to mitigate that cost. You have to shell out dollars to buy these put options and provide that kind of risk downside protection. And so a way to reduce the cost is to sell call options at the same time. So a put option is the right to sell a specific security at a specific price for a specific amount of time. A call option is the right to buy a specific security for a specific price for a specific amount of time. And so if you're buying a call option, you're buying the right to purchase that stock. And if Apple goes to 150, let's say you buy a call option for $100, but Apple goes to 150, then all of a sudden your option is what's called in the money. It's valuable because whereas everybody else has to buy Apple shares in the market at $150, you have the right to buy them for $100. That's immediately valuable. Same goes if you sell call options. So what this means is that you sell options to purchase Apple shares, probably for the same $100 a share. And if Apple goes up, then your shares could be what's called called away, which basically means that whoever you sold that call option to is going to want to exercise if the price indeed goes from 100 to 150. If they don't, they're just leaving money on the table, and investors don't like to do that. So since you sell the call option, you're selling an option, a right to purchase at a specific price for a specific security for a specific amount of time. You're giving that right to somebody else against the holdings in your account. So you get cash for that up front. So if the price goes to 150, you should expect your shares to be what's called away, is the term there. And you would sell them for the stated price on the contract, or $100. So you're taking upside potential off the table in a collar, but you're also raising cash immediately, which you can use to buy the put options. So it's a nice way to seal in your exposure to price fluctuation in a concentrated position, because the whole risk is that the company prospects go south, price crashes, or the market crashes, which drives down the stock price. Either way, your risk is that the value of the stock falls. And if you seal in the value of the shares using a cashless collar, selling call options, using the cash to buy put options, it's a pretty cost-effective way of minimizing or taking that risk off the table entirely without incurring any taxable capital gains. So there are all sorts of fancy options strategies. If I am remembering from my time engaged in this directly, typically when you do a cashless collar, you're not going to raise enough cash to pay for 100% of the put options that you might want to buy, but it doesn't have to be exactly at the money either, meaning you could sell a call for $100, use the cash to buy all the puts for $90. And you're exposed a little bit on the downside, but only in the first $10. There are a lot of complicated ways to draw this up. And when we have run into people in the financial planning firm who want to pull the trigger on this kind of strategy, the specifics just vary widely from person to person with regard to tax situation and really what they're trying to do long term in their accounts and with their financial plans. But nevertheless, it's a solid option that can make sense in a lot of circumstances. Now, strategy number 3 is what's called a donor advised fund. So the first two options were only good for securities companies. Exchange funds work for private companies. If you can find a private exchange fund, public exchange funds good for publicly traded securities. Cashless callers work for publicly traded securities, unless you can find someone who will buy call options and sell you put options simultaneously, which I guess would be considered a security, and the SEC would probably want to know about it. So that being the case, pretty much just publicly traded securities for the cashless caller option at this time. And with the donor advised fund, it opens the door to a lot of stuff. So if you hold appreciated positions in cryptocurrency, this is an option for you, as well as if you own an S corporation or a C corporation that's not publicly traded. There's all sorts of different types of assets that you can contribute into a donor advised fund. So the benefit here, basically what a donor advised fund is it's a mechanism for charitable giving, which is great. You put money into a donor advised fund, you get a tax deduction on it, the money sits in the fund, and then you have the opportunity to advise on how it should be distributed. You do not have carte blanche as far as directing how the funds should be distributed to what charities. You can just make comments on them. Because if you did have the power to allocate the funds out of the fund after being contributed, you would not get a deduction on day one. So it works in a couple steps. Step 1 really is try to figure out, how you might want to benefit charity in the first place. If it's a community fund, pretty much all community funds have one of these because it's a great way to drive dollars into their programs. The brokerage firms have donor advised funds, which have a wider set of charities that you can basically choose from before you make the contribution. Fidelity, Vanguard, Schwab, they all have charitable arms. Other options are not community, but direct. Foundations and charities also have the option to donate in this way. Hospitals have them, all sorts of options. So step 1 is figuring out what type of charity you might want to benefit with your donation, and then choosing a donor advised fund accordingly. Step number 2 is putting assets into the fund. And so the way it works is if you have, let's say you spent $50,000 to buy a bunch of different cryptocurrencies, and now the value has gone up to where you have $1 million of cryptocurrency holdings, you might not want to sell it because your gain or the $950,000 difference is going to be taxed as a capital gain. Well, you can donate all the holdings, if you wanted to a donor advised fund and get a charitable deduction for the full $1 million without having to sell first. That's the tax advantage here, is if you have substantially appreciated positions, you get a big fat deduction, and there are limits, which I'll cover in a minute, on the full amount without ever having to trigger that taxable gain in the first place. Now, the limits are that for a donor advised fund, if you're contributing cash, you can only take a deduction of up to 50% of your adjusted gross income per year. So if you have $100,000 of adjusted gross income, you put $1 million in, you don't get to claim a deduction of $500,000 and then get a whole bunch of money back from the government. Anything that you don't use in year one gets kicked out into year two. You don't lose it. You can keep working down the balance year after year after year, but you can't deduct more than 50% of your adjusted gross income. Now, if you contribute securities or anything else, anything other than cash, I should say, so that includes small businesses, old automobiles, if the donor advised fund itself will take them, publicly traded securities, privately traded securities, cryptocurrency, really anything else that the donor advised fund will take. And each donor advised fund does have different parameters surrounding what they will or won't accept. Anything other than cash gets a deduction that's limited to 30% of your adjusted gross income. Now, if you're contributing Facebook stock to a donor advised fund, theoretically, you're able to claim a deduction in any 1 year of 30% of your adjusted gross income. Anything other than that, anything beyond that gets rolled over, the balance gets rolled over into future years, you continue working it down. With Facebook stock, it's very easy to figure out what the value of that donation is when it's donated, because there's a public market for it. Now, if you're someone who has a private company you want to donate, or an old car, or some obscure cryptocurrency token, you probably want to take some steps to have a more formal valuation done on that asset, because it can be quite arbitrary what the value is on the day of the donation. And if it's a substantial amount to where you will have a balance that you don't use in year one that gets rolled over into future years, you want to have records of what that's worth. Because if you're ever challenged on it by the IRS, it's pretty easy for them to come back and say, well, you don't have records. We don't think it's worth what you said it was, and therefore we're going to disallow all of these years of deductions that you're claiming. Not really a problem with publicly traded securities, but with other stuff, it absolutely is. So step two is you donate the asset. Usually it's an appreciated asset, but cash works great too. At that time, you specify how you would like the funds to be used. Again, you don't have, once the money is put into one of these funds, you don't have full discretion over how the fund actually gives what you contributed to charity. They space it out over time. They have basically the right of first refusal, but you do have the opportunity to advise them and provide your input on what they would like to do. Or what you would like to do. So it's important to find the right donor advised fund in the first place, because there are all sorts of options. If you're looking for something with the widest array of potential charities you could help with your donation, you might want to look at one of the brokerage firms. Again, Fidelity, Vanguard, Schwab, all have charitable giving types of programs and arms that work in the space all the time. If you know that you want to give it to the hospital or the community fund or something like that, then look directly to those funds. Because once the money goes in, and whoever the manager of the donor advised fund is, so that's not you, that's not your advisor or financial planner, that's the management of the donor advised fund itself. Once the money goes in, they may want to sit on it for 3, 5, 7, 10 years before distributing the funds to the charity of your that you would like to benefit, that you've provided your input on. And I don't fully understand all the reasons surrounding why and when and how they distribute funds to the charity, but I suspect it's tax related from their standpoint. So this is a really great option, because donor advised funds, they help charity. They give you a nice fat tax deduction on the full value of an appreciated position. Yes, you don't get to deduct it all in year one, but it's not like you use it, it just spills over into subsequent years. that works really, really well from a tax standpoint. So it's irrevocable, meaning you can't reverse the decision. Once you put the money in or the assets in to a donor advised fund, they're in there for good. That's a drawback. The benefit is that it's a really tax effective way to give to charity. Now, the fourth one may be the fourth strategy for what to do with appreciated positions may be the most complex. But I like this one a lot too, because it does provide a lot of flexibility. It can provide a donation to charity and economic benefit for you and potentially beneficiaries, and provide a whole lot of tax savings. And there are a lot of different ways to draw this up, but it's called a charitable remainder trust. So the idea with a charitable remainder trust is you walk into an attorney's office and ask for help drawing this up in a totally legal way. And what the attorney does is helps you create a trust that is irrevocable, meaning that once you put assets into the trust, you cannot take them back. But assets that you put into the trust are meant for charity when you pass away. Between the time that you donate the assets and you pass away, you can set up an annuity that kicks income back to you every single year. And then when you die, the value of the trust at that point is directed to charity. This one comes in a couple of different steps too. Step one is you create the trust. You put the assets into the trust. So if it's company stock or privately held companies or private securities or cryptocurrency, it works with any of this stuff. You put that into the trust. You cannot take it back at that point. So when you create the trust, you are designating the charity that you want to benefit eventually after you die, that the proceeds in this, or the funds in this trust, should be directed to. Like a donor advised fund, you can put in appreciated securities and you get a nice big fat tax deduction in year one based on that value. So if you have $1 million of Facebook stock, your basis is only $50,000 or cryptocurrency or whatever, you get $1 million tax deduction in year one. It has similar limitations to a donor advised fund though. So if you're giving cash, you can deduct up to 60% of your adjusted gross income per year. Anything else spills over into future years. You work that balance down over time, just like a donor advised fund. If you're giving appreciated securities, the limitation is 30% of your adjusted gross income. So you get a nice fat tax deduction. You put the $1 million of Facebook stock into this charitable remainder trust. You have the attorney draft the documents to create the trust. You go to a brokerage firm, open an account in the name of the trust, and in the legal documents, it specifies the charity that will eventually benefit from those funds after you die, and how much of the funds are to be distributed from the trust each year to give you income. And a pretty common number I've seen thrown around here is, let's say 8%, maybe $80,000 of a $1 million portfolio in this type of account. So the trust assets are managed and invested pursuant to the objectives of the trust. And every year you get a check from the trust for $80,000. So you've gotten a nice big fat tax deduction by contributing $1 million of appreciated securities. In return, you get $80,000 a year distributed from the trust in cash. Unfortunately, that $80,000 is considered taxable income. And it's taxed, I believe it's ordinary income, but it might come in a couple different forms, circumstances depending. Usually, depending on your other income and depending on the size of the donation to the trust, the deduction that you're getting that's limited to 30% of your adjusted gross income offsets a lot of that $80,000 of income. which is very helpful. So you've just turned $1 million appreciated asset that would be subject to capital gains tax if you sell into an income stream of potentially $80,000 a year. Now, you're probably screaming at your radio or iPhone or whatever you're listening to this on saying, well, $80,000 is 8% of a $1 million portfolio. Isn't that twice what the 4% rule would describe? And the answer is yes, but a trust has a totally different time horizon and a totally different risk profile than you and your retirement income do as an individual. And so, I don't know for certain that 8% even works in the eyes of the IRS here. I'm just kind of throwing it out of left field. But I've seen it in documents, and I think that the chances of that blowing up on you, setting up a trust where 8% is distributed, really are pretty low. So you're exchanging $1 million of appreciated asset for an $80,000 income stream of taxable income for the rest of your life. And then when you die, whatever is left in the trust goes to charity. Now, oftentimes, family members will be the ones who are upset with a plan like this. If you've worked for Facebook for 15 years and it's made you fabulously wealthy, and your kids are expecting to inherit a portion of that wealth, then putting your appreciated Facebook stock in a charitable remainder trust that will be directed to charity instead of to them can be problematic from a family perspective. And conveniently, one way around that is to use the first few years of these $80,000 distributions from our example to fund a life insurance policy, probably in a life insurance trust. So remember all the steps here. You've used $1 million of Facebook stock that would be subject to taxable capital gains on $950,000 of it, totally hypothetically. You've turned that into a deduction of $1 million spaced out, or limited, I should say, to 30% of your adjusted gross income every year, and $80,000 of income every year for the rest of your life. So if you're 50 or 60 or somewhere around there, you've got a little ways to go. And you can take that income stream in the first year, where a lot of it is offset by the deduction that you're working the balance of down, and direct it into a life insurance policy that will provide a death benefit for your kids, if you care to do that, upon your death. And when you add up the difference between selling the stock, paying the capital gains tax on it, reinvesting it, and then bequeathing whatever's left over when you die to the kids, you compare that option to putting it in a charitable remainder trust, creating an income stream, and then if you want to provide some death benefit to your kids, kick some of that over into a life insurance policy. This is one of the few examples where a permanent life insurance policy makes sense. Then that's a pretty viable option, and often a far more tax efficient way to go about it. And even better, if you give cash instead of the appreciated position, which is not quite what we're talking about today, you get a much larger deduction. You don't get a larger deduction, but you get to claim more of it earlier, because the limit is 60% of your adjusted gross income, not 30%. So I promised you this one would be a little bit complex, but it has a lot of benefit to a lot of people, particularly those who are in an estate tax situation where you might owe the federal estate tax, or if you live in a state, Oregon, Washington, to name a few, where we have clients, it can be really beneficial there too. The drawback here is that it's a little complex. It's expensive to draw up. You're probably looking at $5,000 to $15,000 of legal fees from an attorney to draw up. So if you have $250,000 of appreciated cryptocurrency or public or private stock that you want to use to contribute to it, I don't know that that's enough to justify the added expense. And if that's you, I would probably look at other opportunities to reduce the capital gains taxes on your position. Once you get north of $500,000, then maybe it starts to make a little bit more sense. Again, circumstances depending. I'm kind of throwing the legal fees out of left field too. I could be a little off on that. But there are options here using trusts to your advantage, particularly charitably focused trusts. And I mean, not only is this personally beneficial, but you get to leave a lot of money to charity too. And then they name a park bench in your honor or something like that. So that's it for today. 4 different tactics for handling appreciated securities that you don't want to sell for tax reasons. Number 1, you have the exchange fund. It works, but it's kind of expensive, not a whole lot of oversight from the SEC. That can be a problem. Number 2, a cashless collar or an ordinary collar where you're matching the up and the downside and maybe going out of pocket to buy the extra put options so that all of your appreciated position is covered. Number 3 is a donor advised fund. And number 4 is a charitable remainder trust. All have their pros and cons. The best fit for you is really dependent on your personal situation and financial plan. As always, talk to your tax people, talk to your attorneys about how this fits in and whether this fits in your situation. But all 4 have pretty helpful tax saving benefits. All right. That's it for this week. I hope I didn't miss anything. I hope I covered it in sufficient detail. I will talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.